In the last 24 hours, Bitcoin punched through $82,000 to hit a 13-week high. But the price action is actually the least interesting part of the story, because right as the market surged, the most entrenched rules of crypto were suddenly abandoned by the exact people who wrote them. Take Michael Saylor. For 5 years, the ultimate Bitcoin maximalist built a corporate identity entirely around a refusal to ever sell his holdings. Yesterday, he went on an earnings call and explicitly stated, quote, "We will probably sell some Bitcoin to fund a dividend." Then you have Reid Hoffman, the LinkedIn co-founder who helped build the modern professional internet, went on the consensus stage and predicted that NFTs are about to make a major comeback. If you're hearing this and getting flashbacks to the speculative hype of 2021, that's the right instinct. But the underlying mechanics driving these moves are different. We aren't looking at bored apes or retail traders chasing momentum. This rally isn't being driven by religious diamond hands or viral marketing. To understand these prices, you have to look at how the volatile sectors of this space are being rebuilt into standard, professionalized financial products. Let's look closely at the Saylor pivot. His company, Strategy, holds 818,000 Bitcoin, nearly 4% of the total supply. Their public valuation traded at a premium specifically because investors bought into their dogmatic never-sell stance. Then Q1 happened. Strategy reported a $12.5 billion unrealized loss when the asset's price temporarily dropped. That pressure forced a pivot. They announced plans to sell holdings to fund a dividend, aiming to, in Saylor's words, inoculate the market. When the single largest corporate holder announces they are finally willing to sell, you expect a panic. You expect the price to crash. Instead, Bitcoin immediately rallied to $82,300. This chart shows why the market didn't flinch. Over just 2 days, U.S. spot Bitcoin ETFs took in $1 billion. Total May inflows reached $1.5 billion. That fresh capital easily absorbs the supply concerns from Strategy offloading coins. Strategy is no longer treating its holdings like a religious artifact. They stated they plan to buy back more than they sell, effectively turning their vault into an active treasury mechanism. They are using the asset as a financial tool to generate yield for the company. The fact that the market absorbed the breakdown of the biggest cult narrative in the space proves the shift in power. Institutional capital has replaced retail believers as the primary driver of this market. That maturation is happening at the product level as well. 90% of blockchain games have shut down, and billions in value evaporated because the speculative buy this picture as an investment model was flawed. Which brings us to Reid Hoffman's prediction at Consensus 2026. He argued that the underlying technology, provable digital ownership, is returning, but strictly as infrastructure. This map illustrates a future internet populated by billions of autonomous AI agents, software booking your flights, managing your inbox, and running business logistics, all interacting on the open web. The immediate vulnerability is trust. When agents ping each other at scale, how do you know the software on the other side is who it says it is? How do you prevent millions of spam agents from impersonating legitimate ones? The solution is on a blockchain. It assigns a unique, soul-bound token to each legitimate agent. This acts as a cryptographically provable ID badge, complete with a history of that agent's behavior that cannot be faked. This infrastructure solves a logistical hurdle for AI developers. It suggests the technology is returning not because of hype, but because a working agent economy requires verified identity to function. We are seeing this demand for traditional structure everywhere. BNY Mellon oversees $59 trillion in client assets. They are currently partnering with regional players in Abu Dhabi to build proper institutional custody rails for digital assets. The regulatory environment is matching that momentum. The White House is formalizing an update on the U.S. Bitcoin reserve. Meanwhile, Senator Lummis is pushing the Bipartisan Clarity Act for a July 4th passage, which would finally establish a federal market structure. On the consumer side, Telegram CEO Pavel Durov is integrating a native Ton wallet for his platform. This places digital asset infrastructure directly in front of 900 million active users, major custody banks, federal legislation, and global messaging apps. Enterprise players learned what they want from the 2022 credit collapses: transparent, standardized, and deeply boring financial plumbing. The term Web3 has largely collapsed as a viable brand. Major industry events like NFT Paris were canceled for 2026, and venture funding for Web3 gaming dropped 93%. This split-screen chart visualizes the reality of this transition. While the left side shows speculative funding drying up, the right side shows utility growth. Stablecoins quietly processed $7 trillion in transaction volume last year. The smartest founders in the space have abandoned the label. They aren't pitching a user-owned internet anymore. They're building internet money, tokenized real-world assets, and agent rails. The story of crypto right now is about installing the plumbum: custody, ETF flows, and stablecoin throughput. If you want to understand where the market is going, stop watching the hype and start watching the infrastructure. The next rally will run exclusively on these new